Good morning, everyone. Central banks around the world are turning increasingly hawkish as we're starting to see persistent inflation play out across most major economies. And this has led to a rising interest rate environment and a general reset in asset prices. We're by no means out of the woods, and there are several geopolitical and economic factors that are still at play, which is really creating quite an interesting and volatile environment for investing. My name is Doug Nickel, and today I'm joined by Tony Cousins, who's the CEO and CIO of Perfect International, and he's one of the four PMs that run the Global Cautious Fund here in our Ned Group Investments Global Best of Breed stable. And today he's here to talk through some of those pertinent issues. Tony, thank you for joining us, and we look forward to hearing what you're going to say. Maybe just to set the scene for our discussion, can you maybe provide us with a backdrop to some of the factors that have driven, I guess, a bit of this disparity in equity markets over the past few years, and and how this has led to, I guess, inflated asset prices?
Sure. Yeah, I think we have to go back to probably the financial crisis and then COVID. Before the financial crisis, central banks didn't print money. It was just left to countries that are in desperate shapes like Zimbabwe or Argentina, who may have done it. But the horrors of the financial crisis legitimized this as a monetary policy tool, and all central banks started to do this. The issue is the degree. Between '08 and 2020, 12 years, they printed about $12 trillion. But then COVID came along, and then in the space of 2 years, they printed another 12 trillion. So they really stamped their foot on the accelerator. And I think we're paying the price for that now. These massive injections of liquidity, coupled with huge fiscal stimulus into the economy, for what has turned out to be, was prolonged, a temporary phenomenon. We've seen a recovery in demand post-COVID, and the world is awash with liquidity. And hindsight's a wonderful thing, but it's clear that they should have been tightening before now. For too long, central bankers sat in the transitory inflation camp. They said that whilst there may be some initial inflation pressures, then these would fall away. But with every single print higher of inflation, they lost more and more credibility. And that camp is clearly totally discredited now, and they have thrown the towel in. And what has come to sight is central banks which are very, very much behind the curve. And they've admitted it. They've made a mistake, and they need to catch up quickly. And that's why we're seeing some hawkish comments led by really the Anglo-Saxon central banks, the Fed, Bank of England, Bank of Canada, the Reserve Bank of Australia. But even the ECB is joining now. An essay recently written by Christine Lagarde, the head of the ECB, was very hawkish indeed. And they realize that their job is to control inflation, and they've allowed it to get out of control and become more entrenched, and this is a problem. We're seeing very tight labour markets, significant rises in earnings. We're seeing rents going up a lot, and rents are 30% of the CPI in the US. We're seeing supply chain disruption by the ongoing COVID zero policy in China, which is restricting supply of many different components and imports. And the only thing really that Team Transitory could still hang its hat on a few months ago was commodity prices. They thought, well, commodity prices have to come down. And then Putin invaded Ukraine. And even that sort of prop has gone away with the huge increases in energy prices, which are now spilling over into food prices in grain, which is locked within Ukraine. And Ukraine is a massive supplier, particularly to the developing world of grain. So we're in a position where central banks are very behind the curve. They have to tighten. They're using a lot of rhetoric, but they're actually starting to see some action now. The effects are really being seen in many areas. Bond yields have obviously risen sharply, and those with long duration have lost a lot of money. Perhaps the most strident examples are the US growth stocks. Growth stocks are long duration equities, in that they may not make a lot of money today, but they promise this pot of gold at the end of the rainbow. So if you're discounting that pot of gold at a very low discount rate, as measured by the 10-year bond yield, you can justify excessive valuations. The problem is that those bond yields have now risen sharply, and that justification has gone away. And particularly in the stocks that disappoint the market in terms of earnings, we've seen some huge collapses. We see Facebook, or Meta as it's now known, Netflix, Snap, the owner of Snapchat last week. Any disappointments are leading to big double-digit percentage point declines in these stocks. And frankly, they have more to go, because this was a huge bubble driven by this excessive liquidity and interest rates, and it's now popping. For us value managers of the world, this is sort of meat and drink to us, and those who concentrate on perhaps more nearer term cash flows. But we do think that this has further to go, and as you said in your introduction, there's still a lot of risk out there.
Yeah, I mean, the scenario you've described there, I do want to touch on equity valuations and how you are positioning there. But before we get there, let's just round back in terms of central bank policy. You've mentioned a couple of risks that they're facing. So there's obviously been an incredible amount of liquidity that was pumped into the markets to keep financial systems running during COVID. But inflation is now rising. It's rising because of wars, because of shutdowns in supply systems, and as you said, wage pressures as well. As a central banker, though, their mandate is to control inflation, but at the same time, try and stimulate growth in the economies. And that, at this time, must be an incredibly difficult task. So, is there a risk of a policy mistake? And what is your thoughts in terms of where that risk could be? Is it going to be, will we in the next 2-3 years be in a situation of higher inflation? Or do you think that there's a higher risk of us actually going into a recession?
Well, it's a very good question, and I wouldn't want Jerome Powell's job at all. It's an incredibly difficult task to perform. And they have now started not just putting interest rates up, but they're going to be quantitatively tightening, and nobody really knows what effect that is going to have. They were buying lots and lots of assets, and now they're going to be selling them, and that is going to put upward pressure on yields. But they do have to bring inflation under control. Now, interest rates are an incredibly blunt tool at the best of times. Most expansions since the Second World War haven't sort of died a national death. They've been killed by the Fed. And we've seen average rises about 450 basis points in interest rates, but from a much higher base than we got to this time. We got to zero interest rates in the Eurozone. They're still negative. And from that point, these are a very blunt tool. If you were able to borrow 1% and interest rates rise to 3%, then your interest costs triple. And that's sort of a huge factor, particularly when many areas of the economy have used this lax monetary policy to take on a lot of debt. So you're absolutely right. There is a huge risk here of a policy mistake, particularly when they seem to have given up using gradualist quarter point rate increases, and are now moving at 50 basis points at a time. So they will be watching very, very nervously to see what effect this has on the economy. And it's very possible that they could drive this into recession. It's a little difficult. I mean, you look at the yield curve in the US, and it is very flat. There's only about 25, 30 basis points between the 2-year and the 10-year, and the same amount between the 10-year and the 30-year. But we have to be aware here of the distortions to the yield curve caused by quantitative easing. A lot of long-term bonds were bought in, and that has sort of suppressed yield. So you would normally expect with the term structure a steeper yield curve. Now, a lot of people are reading into this that the bond market is very worried about recession. I think the bond market is worried, but they're also very worried about inflation. So you've got this huge two-way pull, which is creating a lot of volatility and uncertainty, and this just makes I think Powell's job even harder, because with this distortion in the curve, you can't glean the normal lessons from a yield curve that you would been able to do in the past, because it's been artificially manipulated for a long time. So it is very tough, and they'll be watching data like hawks to see if we actually get a slowdown in the economy. But right now, there isn't any. There is a lot of demand, very tight labor markets. Spending has sort of switched from goods to services, but there's no real sign that it's slowing down. So I think we can expect, certainly for the next two meetings to the end of summer, the foot to be firmly on the brake at the Fed.
Yeah, I noticed that the whole concept of average inflation that Jerome Powell was talking about only 2 years ago has suddenly been replaced with the 2% target again, which I think is a sign in itself. But the situation you described there is quite difficult to allocate capital in, I imagine, because you've got rising inflation, you've got rising you've got rising short-term yields, you've got risk on the long term of your yield curve, which could also raise. So long-term bonds are suddenly not so attractive. But then you also have credit spreads, which could potentially be an issue with the amounts of debt in the system, and potentially a rising yield curve at the long end, and a recession that could play out, which is not a great situation for equities. So when you're looking at this environment, Tony, how are you allocating capital at the moment, and what sorts of assets are attractive to you, both in bonds and in equities?
Well, you're absolutely right, Doug. It's quite a precarious situation, and in these circumstances, fund managers need to remember rule number one of running other people's money, which is don't lose it. Capital preservation is absolutely key until you get a bit more clarity, and you're actually being paid for the risk that you're being asked to take. I think the other thing you have to have in your portfolio is liquidity. You mentioned credit spreads, and while they've gone out, they pushed out a little bit. They haven't pushed out a lot, and as liquidity dries up in the economy, as the QT comes into force, there is the danger of some seizing up in less liquid asset classes like corporate credit, like high yield, certainly private debt. So you unless you're have the capability of taking a very long-term view, you need to mind your eye on those assets. So maintain liquidity, and I think only take risk where you're being adequately remunerated for it. And it's questionable, really, whether there's anywhere where that's the case. Certainly not at the long end of the treasury curve. The real yields are still negative, which is not enough compared to what you should be getting. We think growth stocks still have some way to go on the downside, because their valuations are still high. You could probably say that some of the Asian markets are offering more equity markets, that is, more attractive valuations. But that economy and the Chinese economy, which leads it, is under pressure and is slowing precisely because of this zero COVID policy that's been employed. So, I'm not giving you a lot of answers on how to make money here, but I can give you answers on how not to lose it, and that is to restrict risk, stay at the short duration of the curve, only buy equities that generate strong cash flows, high returns on capital, and very importantly, have low levels of debt. There's been an explosion in corporate debt around the world. Our portfolio has about half the debt to equity of the market, because if you've got a lot of debt and debt becomes more expensive, you're going to pay the price. So it is time to hunker down, but also I think it's very important to have discipline. As markets come under pressure, opportunities will arise, and you need to, at those times of fear, have real process discipline and have clear in your mind the trigger points at which you will buy, and that's what we try and do at Perfect. We set trigger points, and when they are hit, everybody in the investment strategy committee gets an email. We sit down, and we've never ignored one. So that's the discipline to have. It's all very well hiding the curve when things are running fantastically, but you've got to know when to come out of the cave, and put money to work. Don't think it's quite yet, but as markets come under pressure, that opportunity will come.
Thank you, Tony. That's all we have for today. I think some of the pertinent points that Tony has pointed out there is that we certainly are in an environment where there are a number of geopolitical, but also there are a number of macroeconomic factors that could play out and are creating a lot of volatility in expensive equity markets. But that's not all doom and gloom. I think, as Tony has alluded to there, if you do have a process that you can follow in a disciplined manner, there are opportunities that can emerge in these environments, and that's certainly something that Perfect have managed to do in the past, and has delivered a number of periods of strong growth during those drawdowns. So, Tony, thank you very much for your time. Really appreciate your thoughts and comments today. And to our viewers, thank you for joining us. We hope that you found this useful, and we look forward to hosting you with another Global Summit next month. Goodbye.
Thanks, Doug.